So good to see a big crowd here just after lunch. So first disclaimer is we didn't know this was being televised. So we had a lot of interesting questions planned, which we have to tone down now. But let's just do a quick straw poll. How many in the audience think this year will see more capital than last year? Very optimistic room. So just to give a little bit of guidance on what we are planning to do today, we have a very diverse set of folks here. Growth investing, venture investing, balance sheet, off-balance sheet impact, and moving from strategy to balance sheet to fund, right? So, and entrepreneur to investor to entrepreneur. Hope that's official now. It is now. So we wanted to get some of these perspectives in to address some aspects of the investor's mindset, their everyday life. And oftentimes it looks, and for sure it is, the founder's life is extremely hard. There's a lot of friction, a lot of challenges. But maybe the investor's life is not too different. So let's get going. I'm going to start with a topic starting with VT. So let's talk about a situation where you've had a very different view compared to what a founder, in terms of strategy, company strategy, what the founder wants to do. So a couple of scenarios. One is your view was right, and one where your view was wrong, where you had a counter view, and how did that play out between you and the founder?
Oh, straight away diving into...
Straight away. There's no slower ones. We start with the bouncer.
Yeah, I think two examples I can think of both. First is a founder in the beverages space. We were early investors in that company, and I think the real question in that company in terms of ability to scale was what is the price point at which you need to operate. And this founder had come up with an interesting product. It was what I would argue was a premium priced beverage. You know, think of a 20 rupee, 30 rupee price point. And one of my worries always with consumer founders in India is you start with a product that you like, and we forget that we are 1% of India, right? And therefore, the way you have to think about really expanding the market is going down. And what you think is going down is maybe going up or aspirational for others. And sometimes that's a big conflict and a big cornerstone. So I think in this case, my point of view was that if you did not go down from 20 to 10, your market size will not be 1/2, but 1/10, because that's how rapidly incomes fall in India. And this is a big debate, but I think finally reality of the market hit, and for the company to really grow and build the business, they had to go down. So this is an example where I was right. But of course, the founder had to discover this. So I think one of the things you will realize as an investor is you can offer all your views in life, and you can give your point of view. But finally, it is the founder's call on when that information is going to be processed and what the reaction is going to be, because it is the founder's company. How much ever, irrespective of shareholding, right? That is the reality. I do think that here it took time. Maybe it was 18 months late in terms of kind of moving around and figuring it out. That's an example of where it worked, where we were right in terms of how we were thinking about the market. Well, another example, interestingly, is is a premium apparel brand we are recent investors in. It's a more premium than what is available in the mass market, and the founder had built a business digital first, selling online, and he wanted to really build a general trade business, which is find a way to sell in small mom and pop. And my point of view was that it'll be impossible. And I said, look, at this price point, I felt it'll only be online. Maybe you can build exclusive stores, but you won't be able to build a business where you sell to mom and pop. And I think, and the founder started and then realized that general trade did not work, but which is fine, which is anyway our hypothesis. But I think what he was able to do is innovate and come up with a slightly different format for hitting general trade. Which is truly remarkable. I don't think he's truly probably the first of his kind in that category to do what he's trying to do at the store level. Almost think of it as like, a beauty store type approach for an apparel product, which has not been tried before and seems to be having a lot of success with it. So an example where I would say we were completely wrong. I think we thought that it'll be impossible to build, and looks like that may very well be the most attractive business the founder will build.
So your first example, I thought you were pressing a raw point till you actually said the price dropped.
Yeah.
So it's not that.
It is not raw. It is paperboard. Actually,
Yeah. So it coming to you, let's see a different dimension of the same question, where it's not a dissonance with the founder, but with other investors that are there along with you in that deal. Now we'll actually go around on this part where different investors can have different timetables, their schedules, orientation in terms of what they expect out of the investment. So have there been situations where you've been like absolutely sure this is the right thing to do, but you didn't have support from the rest of the board? What did you do, or what didn't you do?
Well, that happens more often than you might be aware of, right? So I'll give you an example of something which happened and then got resolved in a satisfactory way, just a happier story that way. So we had a situation where unexpectedly we had a pretty interesting M&A offer for a company that we invested in, and that zoomed. And it zoomed so fast, and there was so much interest in the company from other investors that folks thought on the board. Now, I'm not saying who said what, okay? So there were multiple directors on the board. One director thought, well, this is going so well, let's put in more money. We'll make even more from where we are right now. Some other investors were swayed by the founder's views that I think this is a great time. We should try to make sure we exit, because who knows what the future holds. And I remember a discussion on the board where one board member is telling the other board member, are you really going to run this company? If the founder believes that there is more value to be selling right now, would you rather be running this, or would you rather be going with the founder's gut? As it turned out, and this is I think what VT mentioned earlier, we might do a bunch of things, but really the reason we are investors is because we're not founders. We're not running the company, we're backing the founders. If the founder tells us that things are a particular way, they have way more skin in the game than us as investors do. If they think this is the upside they want to capture, I think it's judgment. I mean, at some level, we also have to make sure that investors, we stand by our fiduciary responsibilities and make sure the founders are doing the right thing. But more often than not, the founder's view is the view that prevails. And thankfully, in this case, judgment prevailed, and then there was alignment, and we were able to get that interesting M&A that in hindsight, from a financial point of view, made us all look extremely
It's a
smart.
very black and white story that you're talking about there. But I have my own misgivings on that, because we were about to give debt to that company, which didn't happen because they got bought. But Geeta, coming to you on the same question, where the way you're looking at your investments, and we spoke about Ujjivan going back several years, where the legal bill, I think you said, was more than the investment amount, right? And it's come a long way since then. So how do you look at stakeholder management at the board? And we have a couple of companies in common as well, where your objectives could be significantly different from others on the board.
Yeah, in many ways, I feel our objectives should not be significantly different, because otherwise. Okay. So in many ways, I feel our objectives should not be significantly different from any other mainstream investors or founders, because if we are doing that, then we are, sort of pushing the company at cross purposes. We are an impact investor. We are actually a balance sheet investor. We are also a philanthropic foundation. So, we play many roles in that. But when we invest in social enterprises, the idea is we are taking some early risks. We are trying to catalyze a market shift. And then we do want the company to follow the same financial discipline, which it would if a mainstream investor were to come in, because that's how the company will scale up. So taking the example of Ujjivan, when we invested in them, the idea was we wanted to push urban microfinance or catalyze urban microfinance. Many investors thought it was high risk and therefore were not investing. I think Sumit had just set up one branch. There were like 50 customers when we came in. So we took the early risk, but again, the idea was that at the core, the company should focus on urban microfinance customers. We didn't want them to go rural. And thankfully, the urban market picked up. So we had a good sway. But as other investors came in, as long as the target segment focus remained the same, I would say our interests are aligned with everybody else, because we want the market to grow. We want more capital to come in. That's how it will scale. Yes, you could argue that, you know, mainstream investors may have wanted higher interest rates, we may have wanted lower interest rates, but at the end of the day, the company has to sustain in a market. If, you know, if a certain interest rate is what gives it sustainability and the push on the margins, I mean, that's how it will grow. So I feel there are limited instances, Vinod, where we come in conflict with other investors. Timelines, yes. Growth trajectories, yes. There are conflicts because sometimes we may prioritize sustainability over growth or whatever, I mean, just given the balance sheet that we come from. But I feel unless there's a positive correlation between impact and returns, you know, the company will always struggle to make both meet. So I'm trying to see, I think the Dehat founder was here and he was like, I'm commercial, I'm social. I mean, at the end of the day, it's an enterprise which is serving a certain target segment. If you're delivering something positive, it is a social enterprise and then it should meet its commercial returns. But yes, because it was our first investment, we spent more on our legal costs than the actual investment we put in the company. But hopefully the tables have turned now, we don't do that.
Paid off very well. But just to pull that thread a little bit, you talked about the fact that like even Dehat and a few other companies, there is a little bit of an identity question or positioning question on is it for social impact or for commercial impact or for both. Now if it's both and both doing well, it's an easy answer. If only one is doing well, which one matters more?
It depends on the founder. Really, I mean, so for us as an investor, we are impact first. But if, for instance, let's just take the case of Ujjivan, and we said urban microfinance does not work, and in order to make sustainability happen, Ujjivan had to shift to rural areas, which was an easier market. I mean, we may have said yes, we may have stopped further investing, but at least the company would have continued. But having a company that is loss-making, that has no future, and serves our target segment doesn't help. So yes, I mean, somewhere we have to make those calls.
Makes sense. Nicely played. Kitty, you said I can't take certain names, so I won't take those names. But let's talk about timelines, right? In terms of you've done balance sheet, you've done, you're now in a fund. So especially as companies go towards growth, listing, decisions around liquidity, and you have more staying power than your other investors. Have there been any such, say, conflicting situations and you've had to take a strong position either ways? Any comments on that?
Yeah, I think it's very different, balance sheet versus fund investing for sure. At the fund, we are long-term investors because our fund is also 10+2, but I would say as the team running the fund, we are still very mindful that we need to return this money and we have to be answerable to our LPs if there are delays or if we manage to make decisions which end up in loss of returns. So there have been, while we were investing from the balance sheet, of course, you know, a few things. One, when should a company IPO and at what price they should IPO has always been a very big point of discussion, because as InfoEdge from the balance sheet, if we are long-term investors, we are okay if the share price goes up post-IPO and the next 5 years are great, and we believe it will reflect in the market value, whereas someone who wants to take a secondary exit at the IPO, another investor might want to really push the price up at the IPO and sell a good chunk of their shareholding. So in those cases, I think we've generally had a bit of conflict on the timelines, on the price, etc. So that has been one. But having said that, I would say at the fund today, we are also very mindful of those things, and at times we fall prey to saying that, okay, for 2 years, if you're not going to grow and you know, you're just going to focus on profitability, we all want that, we want you to survive, but then at the back of your head, you're always really stressed. You know, in terms of you having gone in at a valuation which probably can't be justified, but on the balance sheet, you were okay with it. You would tell the founder that take 2 years, take 3 years, don't worry about it. So I think these situations change.
Rahul, founder to investor. First question, why? Why did you become an investor? And second is the same conversation around dissonance with an investor. Has your perspective changed? Because you handled it from the other side as a founder, and then you had to give maybe some hard feedback to your portfolio over the last year and a bit. So one is, why do you want to become an investor in the first place? 1A is, why did you choose against it now? And 2 is, how do you see it from a founder's perspective?
I think the decision to try investing, at least, and I was fortunate that Matrix team had a role, and I was able to experiment with in this phase, was simply, I wasn't fully feeling committed to the idea of starting again at that point in time. And I think before your company needs runway, you need emotional runway. And I don't think I'd banked enough, and therefore thought that was the right time to try something else. I felt there was a noble purpose associated, as well as more operators turn into investors. There's an alternate perspective, hopefully, that some of us can bring to the table. So that was the thinking. I think I have greater appreciation now. Obviously, spent a year or so on this side on how not easy the investor life can be. I think I dissed the profession for far too long. I think it's a hard profession in the sense you don't have too much control. At least I've felt so. As a founder, while a lot of things are going wrong, you always felt a certain sense of orientation, a certain effort to reward linkage. I could stop the company in the middle of the month and say, guys, spends down. What are we doing? Is this adding up towards our goals for this quarter? I don't think I could do that in an investing role. So it was a little bit harder, and I have appreciation for how difficult your lives also could be. I think in the tough situations, this comes out more acutely, and people say crisis doesn't build your character, it only reveals it, right? So I have had like any other company that's been around for a decade, Tribo has had its own share of ups and downs and sideways, latest of which was COVID, which is obviously the most extreme case for a travel company where our revenue went down 97%. Deep was talking in the morning about it plummeting 96%. We went down to 97%, almost didn't exist. So we've had our own crisis along the way. And I think that's when different investors tend to, investor isn't a single, it's not a single cohort, right? Everybody behaves differently. So you see different viewpoints around the table. In my experience, the ones that at least founders tend to benefit most from are the ones that have had some kind of Ken. So, knowledge, empathy, and network. And a lot of the investors are able to bring knowledge and network to the game. I think a fewer number are able to bring empathy and true empathy. Amongst, we are fortunate to have a good board, but amongst the people who've added most value, I think there are people who are willing to disagree and commit. So even though they may have a different point of view, they had enough empathy to look into our own personal journeys and say, this is the person that's closest to the crisis. As an example, we got a offer for investment at terms we didn't like from a strategic. Now this was very early in the company's journey, and my gut call was, no, we shouldn't do this now. And everybody else may have, on a certain spectrum may have felt differently. I think the best investors left it to the founders after giving all of the blind spots that we may have had, and we took the decision to not go in, but did it 5 years later. So we've got to, I think VT, you mentioned, people have to find their own comfort in the decisions they take, because founders run the companies and investors are good supporters.
Fantastic. I think I was looking to go to that topic a little later, but let's pull the thread on empathy and fiduciary responsibility, right? So let's jump to Sid. He needs a mic. So the question here is, even in the case that Rahul talked about, in fact, I think I know which time he's talking about. You're empathetic, founders going through difficulty or a difficult problem to solve. If you know very well that what the founder's doing is some level going to hurt, I'm not saying that's the case that happened, if it's going to hurt the company or not, you have your own responsibility as an investor. Where do you draw the line? You've got you're a human being, you are emotional. He said Ken, so there's 1/3 of that you have to demonstrate. So where do you draw the line? Because you have your own responsibility to your stakeholders, your LPs. Thoughts on that?
Yeah, I mean, finally, the money that we're managing is towards a particular purpose. For us, the idea was to be able to create impact with the money and also generate financial returns from the money. And we chose the company and we worked with the founder because we felt those interests were best aligned. And the working with the individual, with the organization could help us get there. See, when something happens that I might not agree with, I might have a strong point of view on that this is wrong, the company shouldn't be doing it. Like every individual, we always have a choice, right? I could always insist and try to build a coalition saying this founder is actually taking the company the wrong way. Let's make sure we replace this founder. And in certain cases, that has happened. But that is rare. I think more often what will happen is that you will provide your thoughts to the founder, and a mature founder will appreciate that where you're coming from is from a place which has the best interest of that company in mind. Because only when the organization succeeds will you as an investor get returns for yourself and your investors, and will the impact that we care about happen as well. And if in the founder's judgment, so long as the founder has my trust, the best thing is to be acting in a way that's different from my advice, so be it. I think we have to make sure that we give the founder the chance to do what he or she wants to do and then prove it. If it reaches a stage when there is no trust, where things aren't working out, and separations do happen. It's rare. And when it happens, it's even more rare that companies recover from those separations, because it's a body blow to an early stage company to have a founder who's closely linked to the organization moving on. You try to avoid that, but you try to avoid that not from a place of fear. You avoid that because that's not in the best interest of the organization. And so long as things are uncomfortable, but you know that there is best effort happening from the other side, I would always give the benefit of doubt to what the founder's doing, because they're doing it with a lot more interest and a lot more self-interest than I could do.
Skin in the game.
Skin in the game, yes.
VD, different thoughts, same thoughts?
No, I was just going to add that same thoughts. The only thing to add is, we've had a situation as well where if the trust is broken, you can also go to a situation where you tell the founder that, hey, this is now a failed marriage, and therefore let's have an amicable divorce, and therefore in the next round just get me out. And I may be leaving some upside on the table, but just don't care. And that has also worked for us, where we've got into a situation where we said, hey, if this is how you want to run the company and your other investors are okay with it, if we're not okay with it, let's just move on. And I think
does that put a burden on the founder to find an exit?
Yeah, of course, it's not like it happens immediately, but I think in this particular situation, it worked out well, where the founder could, there was another investor who was excited, and you said that's fine. And you may be leaving some upside on the table, but at that time, you're not negotiating for the commercials, right? You're just saying, hey, this relationship is no longer working. So what is the quickest way to minimize the damage? But otherwise, the sequence is exactly like what Naughty said.
Different question back to you, which is on valuation mismatches, right? We saw 21, 14, 15 rushes and the kind of liquidity surge that happened. So if you think about decisioning in those times versus today, and not just decisioning, process, diligence, time frames, who goes to whose office, do you call them over, do you camp in their office, and everything is supply demand in some sense. So and you've seen cycles, right? So what are the obvious differences and what are the subtle differences between bull market investing and investing today? It's an optimistic room, but we're nowhere close to high.
I think the tactical stuff, and then I'm talking about the strategic stuff. I think the tactical stuff is in a market like this, everyone seems to have a lot of time. Investors, lawyers, auditors, diligence partners, everyone. So sometimes it's insane as to how long things can take, to close, as they say.
It comes at the founder's expense.
No, I think honestly at everybody's expense sometimes. Sometimes, people just, because you just have so much time, it feels like everyone can take a lot of time, and that not necessarily adding to the value of the decision, right? I think the other material difference, I would say, during markets like this versus markets like 2021 is, I think the person who is making a decision today to invest is truly making a decision to invest. We don't know whether it's right or wrong, but the conviction is real. Because the environment or mahal is like, you know, you're not punished for saying no, right? Versus in 21, you know, there is, I think, massive adverse selection. I think as a founder, you may be getting an investor who's really not investing because he's understood the business, but is investing because it is hot, it is exciting, his friend is saying it's a great investor. And one of the things founders, I don't know whether you're aware, is that the investing community in India is this thin. There's some 150 people who are like having coffees with each other. It's literally that thin, right? So it is scary how much of the conviction can be so easily borrowed. So what you don't know as a founder, I'm taking a founder view in 21 or in 14, is you don't know whether this person is coming on the cap table is really understood why they're coming on the cap table. Which is a risk because it reveals itself only when life is tough. It doesn't reveal itself when things are going. I think that's one big difference. I think the second big difference is one of the things, you know, in the community things is that, you know, when investors come in at a high valuation or a valuation which is looking not so straightforward from the business perspective, they think the burden is actually on the investor. The real burden of a high valuation is always faced by the founder and the company. You know, for an investor, remember, finally at the end of the day, it's a portfolio. And there is a portfolio in terms of time and portfolio in terms of company. The real burden of raising money at excessive prices is always borne by the company because there are two consequences. One, when you really need more capital, you're struggling because, you know, in India, especially in India, you have this notion of down round and up round, and versus saying, hey, this is the market, this is the clearing price, should I raise money? Which is what you would do as a public market company, but people in private companies struggle with that psychologically even today. People delay. You know, companies that should be raising money on time delay fundraising. They're optimizing for existing investors on the cap table because people have come in at different prices. The worst is investors have come in at the highest price, don't want you to raise any more money, and by the way, they also don't have more capital to give you, right? So the
guess which product helps them then?
Yeah. Yeah, you give venture debt and then you push out the problem by 9 months, but the problem still shows up, right? After 9-12 months. So I think that is the other challenge of a bull market, which is when you raise money at high prices, the burden is sitting on you. And the other problem with the bull market raising money is you've raised money so easily, you've forgotten how hard it gets, right? Convincing, persuading people to part with their capital has to be difficult. Because, you know, that's when the capital that comes to you is, you know, thoughtful, efficient, etc. So I think there are lots of differences, but I would say psychologically at least, these are the two big differences. So today when we go and we are investing, we've had one of our busiest years last year and we hope this year will be even more busy, is you are really getting to meet founders who I know are raising capital at a tough time, but they're raising it from a reasonable position of strength because they know they are running a good company and they know they need this amount of capital for a real purpose. And they also know that every person who's talking to them is because their person is seriously interested and is trying to build real conviction of the business. I think that's the advantage. Now, sure, the valuation may not be the highest. But then what that is forcing them to do is to really ask how much capital do I need? And therefore, do I want to dilute so much or do I want to dilute lesser? So every right question, right? How much capital? Is this person really committed? Those questions are easier to answer in an environment like this.
Yeah, so Geeta going for it. So I'm going to come to you, but just one quick point on that is, as long as the founder has 2 term sheets, I think there's enough FOMO created to create competition. And today that's happening for sure for the high quality companies. So it's not like there's a dearth of capital. I think for good quality companies, there's still a fair bit of fight going on to get the right price. But
actually,
love to hear your
I
thoughts.
also wanted to come to the FOMO, but I had one comment to VT's point. I think in the course of my investing journey, I came across 2 founders. One who actually had a higher price on the table, like let's say 500 rupees a share. He came back to the existing investor saying, I'll take it at 400 rupees because I don't want to create the pressure of growth on me. So, you know, I mean that, and
introduce
and
us
our
all
own
to them.
I mean, my own respect for the founder really went up because of that. Another founder who was getting like 4 investors on the cap table and taking double the money versus saying I'll just take it from 2 and I want lesser investors, because these are all in their first 5 years of existence. So you want, you know, more camaraderie or whatever in the investor base. But I also, I mean, not
just on that, was there a correlation to eventual success on the paths?
Yes, it was on both sides. I mean, I just think the boardroom discussions, I mean, they just changed, and the founder also took a lot more control. I mean, in both the cases, they, you know, showed their own strength of whatever, conviction. But I did have one question, maybe for everybody, but coming from VT's point on, you know, things just take long. I mean, it's not because people have time, or maybe it is that. But, I mean, why do we not have more standardized templates, more transparency in the VC market? Like, it almost is like the law firms are making money. It takes like 6 months, 9 months to close a deal. You get what you can, versus when I see like my counterparts in the US, they seem much more standardized. So I don't know if this is the 150 member VC mafia which is getting us there, but I mean, it does come at a significant cost to the founders.
No, I agree with you. I also am constantly befuddled, and sometimes it feels like people are just resetting what their expectations from terms are depending upon the nature of the market. The craziest one is the most recent investment we closed. You know, we could have maybe closed it 2 months shorter, but one of the investors said, I will not give you title indemnity for more than 5 years. You know, so there are crazy stuff which frankly should never be renegotiated, but do get in a market like this, and then you're left wondering. So I agree with you, it's self-inflicted, but I do think the fact that diligence partners and lawyers have more time means they do spend more time. They do have more time.
I think it also depends on the instruction that goes from the investors. That's frankly my view on that. And many companies often face the brunt of it because they're running on fumes by the time they get to close an investment. And we do see a lot of term sheets get reopened towards the end. And some deals do fall off. So it's all of the above. So it's, in some cases, it looks like a very obvious negotiating tactic. And there are some investors, but the thing that investors forget is memories run long. People remember who's reopened term sheets or reneged on term sheets. They will do deals now, but it'll be difficult for them to get the same kind of outcomes when there's a little bit more liquidity. So it's a constant risk that is being run as well. Having said that, there have been actual situations where companies have changed in terms of what they promised and what they delivered. So then that looking at the data again is not unwarranted. But average deal times, which used to be about 3 to 4 months, is now 8 to 9 months, easily.
Don't you think it's a little bit to do with the maturity of the two markets? I don't know if there's another market at the stage of India. I haven't looked at the LATAM market, if it behaves similarly. There are two issues with the vintage, right? One is there are newer founders coming in who've got no experience with this. There are newer funds being set up every quarter. Those guys need to win that deal. They don't have necessarily the brand name or the capital associated. So they may want to fight with terms, slightly more lenient versus so there's a plethora of like options available. Number two, you haven't seen the cycle enough as an investor to know this term is not going to matter at the end. This is not why you will not make the money. There may be many other reasons. So my sense is as that, I don't know if between your first investment in Ujjivan versus now if that's changed and all, I don't think we need standardized terms. I think we need standardized rates for the diligence partners, and then everything else will work out.
Not on hourly basis.
I can agree, and for every budding investor, if there's one piece of wisdom I can give after 15 years investing is, nobody has ever made money on terms. The only time you make money is if the company does well. If the company does badly, nobody makes money. Despite that, there is a reasonable amount of legal fees being charged to the industry every year.
I also, lest it should come across, as an investor self-serving panel saying on the valuations, you should price it right. I've been a founder, I probably will be a founder again, and I can tell you that I've lived that experience. To raise at a very, I'm going back to the previous, to raise money at an exorbitant valuation is the one thing that'll keep you sleepless. I think your company deserves 100% of your attention. The last thing you need to be worrying about is whether you've been able to step into the valuation that you've raised at. If I were to go back, I would just never do that again. And so making a difference between two term sheets that may be high price versus low price, I would just take that out of the equation as long as it's a reasonable price. I would focus a lot more on the person you're going to get into partnership with. I think that's really understated. I think we are at a place where personal brands on the venture capital side are starting to get built. But my sense is in 5 years, people care more about who they're taking money from as opposed to only the terms, or that's what I would hope.
I agree. I think it's also the maturity of the ecosystem where Now there's a personal brand that is visible and people know, okay, I want this partner on the deal, or even other folks in the team. I think that, especially for sectoral expertise, that's definitely coming through. But let's switch gears a bit and look at anti-portfolios, right? The question to everybody is, a deal that you really, really wanted to do, but you couldn't, either because your partnership brought it down or you just couldn't. And guess what? The company went on to do extremely well. So who's going first?
Happy to go first. We keep a running list. Straight off the table, last 5 years, I would say Mama Earth. Clearly a company that we should have been all over and invested, especially in the consumer space. Big miss.
I think we missed investing in a clean energy company called Loham, which you're an investor in. I think it probably shaped the way the industry develops in India, and we couldn't get a hang of manufacturing. We were too close to our idea of services and online-driven businesses. It was too much of a shift for us to make.
So I don't have a public but we missed investing in Stanza Living because we were looking at them when we were still investing from the balance sheet, and there was doubt about conflict at 99 acres, whether it had a strategic fit or not. We ruled that it was not strategic, but by then they closed their round.
Let me know if you're still interested.
You can also say,
Ours, I think my worst one was Flipkart, 2011, venture debt. The warrants would have been enough to pay off a couple of generations.
I haven't been around long enough, so I don't have one.
Yeah, I have a very different. For instance, in the microfinance space, when Equitas came in, we said this is the end of our investing, because as a philanthropy, we don't need to invest in a company that is getting chased by investors. So I don't know whether it's anti-portfolio. Now I'm on the board of Equitas in a very different capacity. But it was a good company, and I think they've done well. And I think from so not a anti-portfolio, but I do feel like we've missed out as a foundation on the whole UPI and the NPCI journey. I think those were path breaking from a fintech perspective, but yeah.
Got it. So Rahul, let me come back to you with a different question then. Let's talk a little bit about the evolution, if any, of the venture capital industry, right? An allied point is, again, you've seen all the hard work being done by founders. Should 220 sustain? That's 2% of fees with 20% as carry. What do you think?
I think I have to answer this from the founder's standpoint because I don't have vintage in the VC world. Yes, please. My sense is just like any other industry, there is a price for every product you can peg at a certain price. There's even 2.5 30. There is a 220. There is 1.5 15, and all of that. I think we are 17, 20 years maybe into this, right? Yeah. I think there are enough markers out there for hopefully people to make more informed calls on what fund managers they can, repose their faith in. If you're, 3xing or even 4xing a large fund, I guess there is a price somebody is willing to pay for that. But most people just haven't had the DPI. So I don't know if in that environment people can sustain that.
DPI, just for people, is the actual money that has been returned to investors on the money that's come in, right?
Yeah.
3-4x DPI in India.
Yeah, total fund returns. So, DPI, I guess people haven't even got to 1x in many cases. So, I think when that starts happening, it should. I guess it's sustained in the West, and that's a much more mature ecosystem. I wonder if that's doable. I think one challenge I face in India particularly is that cycles tend to be longer. At least it's taken me 3 years to understand my own business, then next 3 or 4 years to execute, then there was COVID, and then there is 2-3 years. I think what I struggle to often do is the short-circuiting of time with money isn't, at least in many of the businesses in India, which are very physical in nature, just hasn't happened to the same extent as I would have theoretically, hoped when I started this in this ecosystem. And that does have implications. If not on 220, then at least on, some of the other things around fund structure, fund life, etc.
VT, before that, liquidity that has gone back to LPs, hence LP expectations, and hence 220.
Yeah. No, excellent question. I think I'll just give some background to the audience because they may not realize, right? I think the whole venture capital and private industry in India exists because of America. So that's a starting point. I think up to maybe 98 or 99% of all capital in all private companies in India is largely American capital. And this is coming because the wonderful investors in America have a phenomenal risk appetite. They think about different geographies, different asset allocation. Some small percentage of the global wealth is saying, I want to take extra risk. And that extra risk is coming and saying, hey, I will allocate 1 to 2.5% of my portfolio in India in private, right? That's how the money comes in, and that's all the money in India. And even 15 years into the industry, that's what is supporting the industry. In that context, for it to be exciting for the person sitting in Midwest, who by the way may have more money invested in India than any other city in India, including Bombay, for it to be worthwhile, in this asset class has to generate at least 20% net IRR, right? On a sustainable basis, dollar IRR, which means, maybe 25% dollar IRR gross of fees and carry, which means 30% rupee IRR on a sustainable basis. Now, I think what we are beginning to see, now by nature of this product, it's a 12-year product, right? Which basically means in 20 years is when you will know whether it's working or not, right? And if it doesn't work, America will always gives a long rope, but then when they change their mind, they just leave, right? Which is how it is. That's why they're so successful. So which is what you will see. So the question is, will this ecosystem and community on a sustainable basis deliver 30% rupee IRR over long periods of time? And I think that's the bar and that's the benchmark. And that's not, by the way, the best. The American venture industry returns are phenomenal and staggering compared to this. So there's a real reason for them to say, why should I leave my Midwest and my US and come all the way, to an emerging market and trust money with a bunch of people whom I really don't know, right? I think that's the bar and that is the obligation. And I think therefore the question they're asking, and because they've been long-term practitioners in the industry, is actually not 2 and 20. I think what we don't know is venture capital firm survival rates are terrible. The number of funds, the number of firms which will raise a third fund, the fourth fund, the fifth fund, the numbers fall precipitously. And which I think as an industry, we have not seen that cycle. But in the next 10 years, for sure we will. Because that's the way the capitalism works there. They're not worried about 2 and 20 and 2.5 and 30. They're saying, you're not performing, 10 years into the business, you have fund 1, has it delivered, not delivered, thank you very much, I'm leaving. So mortality rate in the industry is actually much higher than people think. Today, sitting in India, it looks like, investors, cushy job, you sit there. What you don't realize is many investors, after 10 years, you really have nothing to do for the rest of your life. That is the risk for the investor and people entering the investing profession, and that's the risk for the business. And I think that is how the risk will play out. I don't think it will play out in fees, it will play out in survival rates.
Is there an instruction?
Sorry to interrupt the conversation, but if we can wrap up in a couple of minutes so we have some time for questions as well.
Okay, I thought we were halfway through. No, I think the thing I wanted to ask both of you was, you have 2 LPs, you have 1, right? So how does that play out?
For us, actually, it plays out really well because both the LPs...
Well answered.
But it does. I'm super happy. We do not spend much time in LP management. They're both very patient, long-term capital. It helps that both the LPs have had very long-term relationships, at least personally with me, a decade plus, each of them. So they're very relaxed. And I love the structure. I think anyone who gets to have like a very concentrated LP base, which has very deep pockets, high levels of trust, and of course, you do a lot of the things that you think are very important for them. So all the governance checks. At times, you let go of certain transactions where you feel they might not be comfortable, and that's okay. In the long term, you're trying to build a relationship with them. But overall, I would say it's just been a blessing, seriously.
Follow Kitty. Yes, it's good to have a single LP. I think but I mean the downside is the name gets associated, so the governance and the pressure of the brand becomes even higher. And second is, if the LP makes up their mind that the Indian edtech market isn't going to perform, it's there is no counter. I mean, you can keep on sharing data, but so yes, I mean, all in all, I would say it's good because there's one person you need to, or like one family you need to manage, and you're not raising money from 10 different investors. But I mean, the only downsides I would say are those two.
Yeah. So actually on the 220, I'd like to add something. I have a slightly different view. I mean, and it might be conflicting to what people want to hear, but I think investors are an unreasonably paid set of people. I have fundamentally never understood why people who go into investing are paid way higher salaries than those in operations. And what is that skill set which they bring or they build which merits them believing that they are so highly valued? I've been in the community for now 11 years plus. And so at our fund, even when we were having this conversation and they wanted to give us market rates, etc., we actually consciously made a call and we actually said we don't want people to get rich on salaries. If they want to, then this is not the place, because we don't think that's how this works. You need to get wealthy on carry, which is your profit sharing. So if you're going to perform, then it all gets made up. But fundamentally, I think 220, my belief is it's flawed, because the returns, I think, that are expected out of venture capital as an asset class, they have not been delivered historically, even in the short period of time that India has seen. I think it's a very, very high bar for anyone to cross. And I don't think all of us investors are bringing something so unique and amazing to the table that we deserve to have the 2%. I firmly believe that.
I think it's a valid point of view. And short answer is it's a short time frame. And hence the test is over a long time frame. I agree with VT on that, which is the first fund, you get your fees. Second fund, maybe, if you're around for your third fund or not, depends on performance. And you can skim off fees for one or maybe two vehicles. The LPs are a smart bunch, and they look at, and now the dispersion is showing in India. So 8 years ago, 4 years ago, it was very different. Today, I think you have 30 venture capital funds you can pick from, 15 growth funds, few venture debt funds. Performance is visible. So it's difficult to skim off on fees. Now, then it's a question of real performance, what is the real value, and beauty in the eyes of the beholder, right? So if LPs want a particular fund, then they pay for that. But for the short term, agreed. And the last thing is the new fund manager, I would say there are frictional costs. So it's actually a curve, right? So your first fund, you want a little bit of generosity, the leap of faith. Second fund, cut down a little bit. Third fund, purely performance. If you're not performing, you shouldn't raise money. It's not about fees. You don't deserve to raise money.